Start at the very beginning, the origins of currency markets. Thousands of years ago, people relied on the barter system, exchanging goods and services directly. Imagine a farmer trading wheat for cotton or a dairy farmer struggling to swap a cow for salt. Barter had its limits, goods weren't always divisible, transporting them was costly, and valuing services was tricky. These challenges sparked the need for a common medium of exchange, leading to the invention of money. Over time, various commodities were tried, but metals like gold and silver became favorites due to their portability and universal acceptance. Eventually, metal coins, especially gold, became the standard, paving the way for the evolution of paper currency. As societies advanced, carrying heavy coins became impractical. People began depositing gold and silver with banks, receiving paper notes in return. These notes promised the holder a specific value in gold or silver, marking the birth of paper currency. This innovation made trade easier and more efficient, allowing economies to grow and international trade to flourish. The concept of exchanging one country's currency for another's emerged as global trade expanded, setting the stage for the foreign exchange market we know today. In the late 19th century, countries sought a universal way to value their currencies. The gold standard was born. Currencies were valued against a fixed amount of gold. Central banks issued paper money backed by gold reserves, and exchange rates between currencies were determined by their gold values. For example, if 1 unit of gold equaled 10,000 INR and 500 USD, then 1 USD was worth 20 INR. This system brought stability but was eventually challenged by global events like wars and economic crises. Gold standard couldn't withstand the pressures of growing international trade and political upheaval. Countries gradually shifted to floating exchange rates, where currency values were determined by market forces. Central banks began intervening to manage their currencies, buying or selling as needed to maintain competitiveness. This shift marked the beginning of the modern foreign exchange market, where supply and demand set currency values in real time. Today, most currencies are fiat money, government-issued currency not backed by physical commodities like gold or silver. Instead, their value comes from trust in the issuing government and the balance of supply and demand. The US dollar, euro, and other major currencies are all fiat money. The gold standard is now a thing of the past, replaced by this system where governments declare their currency as legal tender. After World War II, the Bretton Woods system was introduced, blending the gold standard with fixed exchange rates. All currencies were pegged to the US dollar, which in turn was pegged to gold. The US guaranteed other central banks could convert their currency to dollars at a fixed rate, and the dollar's value was tied to gold. This system made the US dollar the world's dominant currency and led to the creation of the International Monetary Fund and the World Bank. In 1973, the Bretton Woods system collapsed. Countries could now choose how to manage their currencies, linking to another currency, a basket of currencies, or letting them float freely. This change required a market where exchange rates could be determined in real time, giving rise to the modern Forex market. Developed countries moved to market-determined exchange rates, while developing countries often used pegged or managed float systems. Currency markets, a clean float means a currency's value is set purely by supply and demand, with no government intervention. In contrast, a dirty float or managed float involves central banks stepping in to influence currency prices. Most countries use some form of managed float, allowing their currency to move within certain boundaries and intervening if prices move too far. This helps maintain stability and competitiveness in global trade. Foreign exchange market revolves around currency pairs, where one currency is traded against another. The most traded pairs, known as the majors, include EUR-USD, USD-JPY, GBP-USD, AUD-USD, USD-CAD, USD-CNY, and USD-CHF. These pairs are highly liquid and follow free-floating valuation. According to the Bank for International Settlements, EUR-USD is the most traded pair, followed by USD-JPY and GBP-USD. Not all currency pairs involve the US dollar. Minor pairs or crosses are combinations of major non-USD currencies like EUR-GBP or EUR-JPY. These pairs are still liquid but have slightly wider spreads. Exotic pairs combine a major currency with one from an emerging market, such as USD-TRY or EUR-TRY. Trading these pairs exposes traders to new regions and higher volatility. US dollar is the world's most traded currency, serving as the primary vehicle for global transactions. Most currency trades involve the dollar, making it central to international finance. Traders often use the dollar as an intermediary when exchanging less liquid currencies, reducing the number of exchange rates needed and increasing market efficiency. This dominance is reinforced by the size and strength of the US economy. Euro is the official currency of 20 European Union countries and is the second most traded currency globally. Managed by the European Central Bank, the euro plays a significant role in international transactions and reserves. Its stability and widespread use make it a key player in the Forex market, second only to the US dollar. Japanese yen is the third most traded currency, known for its liquidity and use as a reserve currency. The British pound or sterling was once the world's reference currency and remains heavily traded, especially against the euro and dollar. Both currencies are important in global finance, with the yen often used in funding strategies and the pound holding a strong reserve status. Swiss franc is considered a safe haven currency, prized for its stability and Switzerland's independent financial system. The Indian rupee, managed by the Reserve Bank of India, operates under a managed float regime. While the rupee's exchange rate is market-determined, the RBI intervenes to reduce volatility, making the INR unique among emerging market currencies. International currency market is a vast, decentralized network where banks, corporations, central banks, hedge funds, and investors trade currencies. It facilitates global transactions from trade to investments. The Forex market operates 24 hours a day, with trading centers opening and closing across different time zones, ensuring continuous price discovery and liquidity. Forex trading involves buying one currency and selling another as a pair. Prices are determined by supply and demand, with economic developments in each country influencing currency values. The market is highly liquid, and trading can be done over the counter or on exchanges. In India, both interbank and retail segments exist, with banks acting as market makers and quoting two-way prices for buying and selling currencies. Forex currencies are always traded in pairs, such as USD INR or GBP USD. The first currency is the base currency and the second is the quote currency. The price tells you how much of the quote currency is needed to buy 1 unit of the base currency. Quotes are given as bid buy and ask sell prices, with the difference known as the spread. Understanding these basics is crucial for anyone entering the currency market. Currency pairs can be quoted directly or indirectly depending on the country. In a direct quote, the foreign currency is the base and the local currency is the quote. In an indirect quote, it's the opposite. Most countries use direct quotes, but some prefer indirect. This distinction affects how traders interpret prices and make decisions in the market. India's Forex market is divided into interbank and retail segments. The interbank market involves large volume trades between banks and institutions, while the retail market serves individuals and smaller businesses. Banks act as market makers, quoting two-way prices and ensuring liquidity. Retail customers can access Forex through banks, electronic platforms, or multi-bank portals, with new platforms like FX Retail enhancing transparency. The interbank market, currencies are quoted with two prices, the bid buy and the offer or ask sell. The spread between these prices reflects market liquidity and efficiency. Narrow spreads indicate high liquidity, while wider spreads suggest less activity or higher risk. Understanding how spreads work helps traders assess market conditions and make informed decisions. Exchange rates are always changing, leading to appreciation or depreciation of currencies. If the base currency buys more of the quote currency, it's appreciating. If it buys less, it's depreciating. For example, if USD INR moves from 82 to 83, the dollar has strengthened against the rupee. These movements reflect economic conditions, market sentiment, and global events. India, the Foreign Exchange Dealers Association, sets market hours for interbank and client transactions, typically from 9 a.m. to 5 p.m. IST. Some transactions can occur beyond these hours, but banks must manage their risk carefully. Market hours overlap with Asian and European trading sessions, allowing for effective price discovery. However, events outside these hours can impact opening rates the next day. Banks quote Forex rates for spot deliveries as the base rate, adjusting for cash or spot differences. Card rates are published at the start of the day for retail customers and may be revised during high volatility. The difference between interbank and card rates covers the risk of price fluctuations. Each bank sets its own charges, ensuring fair pricing for all customers. Price discovery in India's Forex market happens mainly on electronic platforms like Refinitiv and CCIL. These platforms match orders and allow for negotiated trades, ensuring transparent and efficient price formation. Trading volumes vary throughout the day, with spot trading distributed evenly and forwards peaking towards the end of the session. Non-delivery forward NDF markets also play a growing role in price discovery, especially during volatile periods. Financial Benchmarks India Private Limited, FBIL, computes and publishes reference rates for major currency pairs like USD INR, EUR INR, GBP INR, and JPY INR. These rates are calculated using transaction data from electronic platforms during a specific time window each business day. The process ensures transparency and accuracy, providing a reliable benchmark for market participants. Forex transactions can be spot or forward contracts. Spot trades settle within 2 business days, while forwards are set for a future date. The settlement date or value date is when currencies are actually exchanged. Understanding these timelines is crucial for managing risk and planning transactions, especially when holidays or different time zones are involved. Not all currency pairs are directly quoted. Sometimes cross rates are calculated using underlying pairs. For example, to find EUR INR, you might use EUR USD and USD INR rates. The process involves multiplying or dividing the relevant rates, always keeping track of which is the base and which is the quote currency. This method is essential for trading less common pairs. Currency values are influenced by a mix of local and global economic factors. In the long run, a country's economic strength, like GDP growth, inflation, and trade balance, shapes its currency's value. In the short term, demand-supply mismatches, political events, and global risk appetite can cause rapid movements. Traders must monitor both domestic and international developments to anticipate currency trends. Several economic indicators have a direct impact on currency markets. GDP growth, industrial production, consumer price index CPI, real interest rates, trade and current account deficits, non-farm payrolls, retail sales, and central bank actions all play a role. Each indicator provides insights into a country's economic health and can influence currency values, sometimes in complex and unexpected ways. Interpreting economic indicators isn't always straightforward. For example, strong GDP growth might suggest a stronger currency, but global factors or market expectations can change the outcome. Sometimes even negative economic news can strengthen a currency if investors seek safety, as seen with the US dollar during financial crises. Successful traders learn to analyze which indicators matter most at any given time, and how they interact with global trends.